In today's video, I'm going to be completely breaking down the Asian session liquidity and how to properly trade them. The Asian session liquidity or the Asian session manipulation is the most powerful way to identify liquidity in the market. And learning how the manipulation works can help you greatly if you want to beat the market maker in Forex and other financial markets. Now, let's get into the video. Now, I'm going to be breaking this down completely, so make sure you pay close attention because what I'm going to be giving you here is paid. A lot of people pay money for this type of knowledge, but I'm giving you here for free. So I think the least you can do is give the video a like and subscribe to the channel, and also share to your friends who you know might need this information, right? So let's get into it. So when it comes to the Asian session liquidity, there are various patterns that go on, but I'm going to be showing you the main one. Now, the reason I drew these two lines here is going to be indicating the Asian high, the high of the Asian session, and the low of the Asian session, which is also the high of the day and the low of the day. Now, let's say the day begins here, right? So the market basically begins to consolidate and bounce off of this high and low, which a lot of people call resistance and support. So the top one is resistance, the lower one is support. Now the market bounces up and down. Now this is basically sideways movement consolidation, and this is really not a trend. Now you're going to be having equal highs and equal lows, not every time, but you're going to see that the market isn't really going anywhere during this session. All right, so we have three main sessions: the Asian session, the London session, and the New York session. Right. So first of all, we start with the Asian session. Now this consolidation does two things. It induces traders to take positions, those people that trade support and resistance. And you know, support and resistance is one of the most popular trading strategies in the trading world. Now, a lot of people would be taking buys and sells inside here. Now, the way it works is, we know banks and the big banks, the hedge funds or market makers, smart money, whatever you want to call them, they are mainly the ones that move this market. Now, this consolidation or this sideways movement is not a mistake. It is done on purpose, and the reason for that is to create liquidity. Now, the way they create this liquidity, they get people to buy and sell, right? People buying the support, people selling this resistance. Now, that basically, for example, let's say you have 50 million in sells and 50 million in buys. Now, we know the way the market works is you need, for 50 people, if you have 50 million in sales, that means you need to have an equivalent of 50 million in buys. So for example, if you have a buyer, you have to have a seller, right? So we know those orders have to be filled. Now, if the market makers or the smart money want to move down, they want to head down for the day, what they'll usually do is they will induce people out of this consolidation. Now, this inducement does two things, right? First of all, it hits the stop losses of those who took sells, who were selling this. It hits their stop losses, and at the same time induces people to take this long. So people that trade breakouts, they take this long. And not only that, because we had 50 million sells or 50 million in shorts, and we had 50 million in buys or longs. Now, this creates this move right here, this breakout, basically creates an imbalance. So instead of 50-50, now this move changes these numbers from 50-50. Now you have probably like 20 people in shorts, and let me change this real quick, and you'll have, let's say, 80%, or let's say 80 million in buys. Now this move took out 30 million sell orders, right? And then that means we're gonna have more buyers because more people are taking these buys, and the ones in this that took buys here are still on buys, right? So now we have 80 million buys and 20 million shorts. Now, what usually happens is the markets, now pay close attention to this. The markets usually, the when breaking out, they'll usually make this breakout, they'll push it up 3 times, right? Now, why 3 times? The main reason is because of the market is based on emotions, right, and psychology. Now, human beings react to number 3. This third number. So now, when the market first breaks out, not a lot of people get in on buys here. But when they see this second push, for example, you might be looking at the chart and you see this breakout and you're like, I don't think I'm going to take this on a buy. Now, this second push, when you see the second push out of this area and breaks this high, you're like, maybe I could buy this. Maybe the market is going up for today. And then when you see the third push, that completely confirms that, yes, this market is going to the upside, right? This is an uptrend, right? And remember also, they also teach us that in an uptrend, the third touch to the trend line confirms the trend line, and also support and resistance. The third touch to the support or the resistance makes it stronger and also confirms that zone, right? So that number 3 is very significant in psychology and emotions. Now, they break out in 3 pushes. So we have 1, 2, and 3, right? Forgive my drawing. Now, what usually happens is on this third push, they'll basically make a pullback like this. Once they make this pullback, they'll begin to consolidate. Now, this consolidation is done on purpose. Now, this consolidation, what it does is it creates another liquidity, right? So what they basically did here, they're going to repeat it here too. Now, what a lot of people see is this is an uptrend now, right? Higher highs. We have this low right here, higher low and higher low, right? And then we have higher highs, and the highest high. So this is basically the high of the day, the highest point for the day. And initially the high of Asian was the highest point for the day. Now, I forgot to mention this. After Asian session, we have the London session. So basically this move happens during London session. Let me just clear this out so that it looks a little bit cleaner. Right. So let me see. So this area here, this whole thing is London session, right? So this is Asian and this is London. Asian session is the consolidation. The breakout is London session. Now, what happens is we have higher highs, lower highs. Sorry, higher lows, right? So a lot of people are anticipating another higher low. So what people think is, since this is an uptrend, right? Showing characteristics of an uptrend. Now, people expect this to happen, right? Because if you think about it, they broke out, they pulled back, they set the low, they broke this high, they continued up, right? They set this high, they set the low, they break this high, they continued up. So what is the most likely move they're gonna make? Like what just automatically comes to your mind when you see this, when you're analyzing this chart, that they have set the low and then you're gonna wait for them to break out, to break this high, and then you're gonna enter in on buys, right? So now they create this liquidity here. So the traders who look at smaller time frames, maybe like the 5 minutes or a 1 minute chart, they are mainly the ones that see this consolidation. Now, they do the same thing that they did. They create the liquidity, right? Now, they break out of this area. They break out, confirming the directional bias of everybody. Everyone is seeing buys, uptrend. They're breaking out. So people enter here on buys. The smaller time frame traders, they enter here on buys. Not only that, the ones that are seeing this as an uptrend, breaking higher highs, they're going to wait for them to come back to this high. Maybe when they see a break, they'll take this up. So remember also, what just happened? Yeah, remember also, we have 20% selling and 80% buying. Now, these numbers could be higher. This could be 90 and this could be 10. So I'm just using this as an example. So what happens now is when they head towards that high, then we draw the high. When they head towards this high, what basically there are 3 things that usually happens at this high. Now, those 3 things are basically 3 things in one, right? So we're going to get an M formation, or you can call it a double top. But now there are 3 variations of this, which are the 3 things that can happen there. So you're either going to get this where they come near the high, but then they don't really come to that high exactly. Or they could come to the high and form equal highs. and don't break that high. So this will be equal to this, right? And the third one they can do is they can break that high and enter back in. So this high will be higher than this one, right? Now, why do they do these three patterns? They do it on different occasions, right? Now, the main thing is because now why they don't come back to this high is that if they don't come back to this high, the reason why is they have a lot of traders who bought in here, so they don't want to release those traders, because if they go any higher than this, they'll release those traders or put them in profit, and maybe they'll close in their trade. Because think about it, if you get in on a buy here and then immediately the market bursts down, puts you in large drawdown. Now, if the market comes back, maybe you might be thinking, okay, if this market just comes back to break even or a little bit of profit, I'm going to close my trade and look for another setup, right? So they don't allow that. So they just come a little bit close, maybe show you like -5, -10, just a little bit of loss, then and then they shift out of that area immediately, right? Putting you in more drawdown than you were, before. Now, the second type, which is this one, what usually happens in this one is the reason why they don't break this high is because of they have a lot of they don't really need to break the high. So let's say a lot of people took sales in here and their stop losses are above here. What they usually do is they'll come to that exact high. Now they don't need to break that high. What they'll do is they'll just open the spread a little bit to take out all the liquidity that is above that high and then come back down, right? So, or sometimes they could just throw, maybe put a wick in there. Now this wick is to take out all the stop losses and also hit all the buy stops, right? All the buy stops, those who can't look at the charts, who put buy stops there, expecting the market to, once it breaks that high, so it will continue their uptrend, right? Because we have, remember, the London session in one time zone could be the morning of that. For example, in London, the London session is the morning, right? That's early morning when people wake up, right? But in the United States, London session is usually when people are asleep. Now, those who are asleep, they'll just put their buy stops and probably expect to wake up in profits, right? So what they usually do is they'll spike this high a little bit like this, throw a shadow or a wick there. The candle won't close above, it will close below. So this is equal highs. Now, the third type is where they break the high, but they enter back. So in this scenario, they don't just throw a wick inside there, they'll actually break above, right? All these things I'm saying, it also applies for the W formation, the double bottoms. Now, the candle will close above, and then the next candle or the next three candles will come back inside here, right? Now, what this does is this is a stop hunt. While this is not really a stop hunt, it's an inducement, right? A stop hunt is them hitting the stop losses, while an inducement is them inducing people to take buys. Now, what usually happens is when they close above, that's a confirmation they've broken the highs. So a lot of people take buys in here. Now, a lot of people will be entering in there, and then they shift the zone out of that area with speed, and then this happens. So now these are the three things that can happen in there, right? So let's go back to the drawing. Now, let's say, for example, they break the highs and then they'll come back in like this, right? So now this is the consolidation. They broke out and then they reverse. If you go on a smaller time frame, you might even see a tiny M formation right there, right? Now, what happens from here is what they'll usually do is they made 3 pushes up, they'll also make 3 pushes back down. So they'll also push the way they went back up is the way they'll come back down. So they'll push down 1, 2, 3, and they'll usually go below this consolidation, right? They'll go below this consolidation. Let me just clear this out to make things more clear. All right, so yeah, they'll make 3 pushes back down, 1, 2, 3, and basically repeat what they did there, right? Start their consolidation and then push back down there, and then what they'll do is they'll end the day in consolidation. Just the way they started the day, that's the way they'll end the day. All right, so now because of before they made this move, they have already induced people. So now we have 80 to 90% buys. Could be any number, but this will be greater than this, right? So this could be 70, this could be 30, this could be, so this would be not this buys will be greater than this sells, right? So that creates an imbalance. Now who's gonna fill these orders? The banks, right? So the banks are the market makers, the banks are the ones that are going to fill this order. Now, because a lot of people are buying, so they have to be, if 80 million are buying, 80 million are in buys. So now 20 million are in sales. Now they need to balance this. And so they'll be the ones to balance this out. So now they'll basically add 60 million in sales. So this sales is the volume is up approximately 60 million in sales, right? So they'll take this down to be equal to this, right? 60 plus 20, that's 80, right? So the people who took buys, the banks are going to fill their orders and take this back down, right? And then they'll do the same thing here, because this whole move is going to create an imbalance, because by the time they get back down here, there will be an imbalance. So that's basically how they manipulate these markets, right? And there are variations, there are different variations of this pattern, right? Sometimes they won't even give you the information if they have enough money, if they have enough liquidity, and they don't need to go back to that high. What they'll usually do is they just consolidate and then continue down like this. So you just see this high, consolidate like this, and then they don't need to go back up here. They'll just continue down, basically. And all this also works inversely. If they break down first, you can expect the same thing back up. So now I'm going to show you guys examples of this on the charts. Now let's get into the examples. Also, if you're enjoying this video right now, so like and subscribe, and let's get into the examples. So right here, I have an indicator that already shows the Asian session, the London session, and the New York session. So this is the Asian session, the gray box. The London session is the first red box, while the second red box is the New York session. Now, to get this indicator, just type in FXN on the indicator tab, or let me just show you. Yeah, so this is it. FXN Asian Session Range by Rob Minty, or you can use the second one, FXN Asian Session Range and Week and Day Separator by Billy FX. They are basically the same thing. I don't know why it has different creators, but it's the same thing. So you can choose any one you want, right? So you basically have these boxes, but you won't have the same colors. I am the one that customized the colors to be like this, right? So you can customize it in settings. Let me just show you this. Let me just show you the settings. If you go over here, settings, so you can see the colors. You can change the colors and the backgrounds, and also the timings, EST, and stuff like that. Right. So let's get into the examples now. You can see also this. You see these vertical lines. They indicate the start of one day and the end of that same day to start a new day. Now, so this is day one, day two. This is Thursday. This is Friday, and this is Monday, right? So if you want these vertical lines, you can just right click on your chart on trading view, go to settings, put appearance, session breaks. That's what creates those lines, and you can change the color and change all this, right? So let's get into the examples. You can see 3 days in a row you have that same pattern. You can see the consolidation, they break out, consolidation, they break out, consolidation, and they break out. So now let's go into the deep dive of these examples. Now let's start from here, right? So what can we see here? We can see the start of the day, right? Start of the day right here, and we can see the market consolidates for, now the consolidation usually lasts for about 8 hours, Asian session. So from here to here would be about 8 hours, right? You can see 8 hours. Now, you can see what happens here is, remember, liquidity is here, liquidity is here. All right. So now, they burst up in 3 pushes. So this 3 push, this can also be in 3 candles. Can be in 3 candles like this. One, then the next candle, and then in the next candle it could be like this. Sometimes it could be in one big fat candle, right? But if you drop down to the lower time frame, you basically see three pushes or three candles in there, right? Remember, the 5 minutes is three 15-minute candles, right? So the 5 minute broken down is three 15-minute candles. So if this is a 15-minute candle, you can see you most likely see three 15 minutes, three 5 minute candles in there, right? So here we can see if we draw the line from here like this, we see that the market breaks. This is the first breakout, right? This is the first breakout. You see 1, 2, 3, right? With the third one being very aggressive. Now, a lot of breakout traders are entering trades in here, right? And their stop losses is either below this or below this. Now, they go back up there, they come back down. You can see they consolidate for about an hour. All right, so you see these candles spike up, spike down, close at the middle, spike up, spike down, close at the middle, spike down. This is a hammer. So these are basically consolidation candles, right? They're not going anywhere. Then all of a sudden you have a push back to these highs. Now, if you zoom into this and you draw a horizontal line, what can you see here? You can see that they go back to that high. You can see they don't close above. They just throw this wick above. Now this wick takes out any pending orders here or any stop losses in here. That's the purpose of this wick. And you can see they don't close above. And then the next candle, now this candle was only initially above here, but you can see they came back down to close below, and then the next candle opens up, and then that next candle comes back down, gives you an engulfing candle, and then they consolidate for about 30 minutes and they push down. Once they push down like this, that's lights out. They're gone, right? And you can see they go back down, hit the stop losses of all the people who took buys in here, hit their stop losses, and end the day in consolidation, right? So if you're going to take sales in this, you're going to have to take sales in here and then probably put your stop loss above the highs, and then you can take this down. This could give you about a 1 to 4, 1 to 5 risk to reward. Now, if we go to the next day, what can we see here? This is very clear. You can see the first breakout, that's the first push. The second one, they push, pull back. They go again, push back, and they give you this information, right? The easiest way you can see this is if you change this up to a line chart. So you can see this is 1, 2, 3, and then they give you this information, right? So we see the consolidation in here like this, right? Consolidation, they break out 1, 2, 3. They give you this information. Now, if you draw a line above this, you can see they break out, they consolidate above this structure. Why did they consolidate above this structure? This is to ensure that a lot of people get in here. Now, this consolidation takes about 1 hour, 30 minutes. Now, they stay above this high to get a lot of people to enter in here. People who aren't on the chart, who came on the chart, they are basically entering buys in here. You can see they gave confirmation candle. So this could be an engulfing candle to take this long. This is a breakout candle, take this long. This is another breakout candle. This is almost an engulfing, but not fully an engulfing candle. So you can see they're basically giving you confirmations to take this up, to take buys on this. And then immediately they shift out. You can see how they shift out of that area. So the people who took buys in here, they are put in drawdown immediately with just one candle. You see how there's no wicks on this candle, right? And if you look at the previous one too, you can see how there's no wicks on this candle, barely no wicks on this candle. So it's called a shift candle. It's used to shift out of, once they're done trapping, they shift out of that zone. Now you can see the M formation, you can see they set the high and then they come back down. You can see they consolidate for a while, creating liquidity here and here. They break out, getting more people to buy, stay there for some time, and then come back in. Your job is to take this sell right in here, put your stop loss either above here or you can put it here, right? And you can see they take it back down. And then they go back down in 1, 2, and you can say 3 and end the day in consolidation. Now, not every time they'll give you the 3 pushes back down, but you know what I mean. Now, the next day, what can we see here? We can see this consolidation. You can also see a little consolidation in here. You can see this. Now, the reason why they didn't break above, you see the way they broke out of that area completely, and also here. Now, the reason why they didn't break above so much in this example, is because if you look at this is already the liquidity that they've created here. So this is basically the main liquidity, and this is the main breakout, right? But still, they have to go back to that high. So they have to go to that high, spike that high, right? Spike the high, take out remember, people are selling here, the stop losses are up here. But for those who sold, and for those who bought, the stop losses are here. Now, what they do, they create this M formation. If you change this to a line chart, you can see that clearly, M, right? And then they go back down, right? And they end the day in consolidation. And you can see basically the same thing is happening here. So today you can just expect an M formation like this to continue down. And also, let me just show you this last example. I remember this trade on Friday. So this was basically NFP. This was the last Friday. This was the first Friday of the month. You can see Friday, 5th February, 3rd February. Now, what they did was they consolidated all the way in here. They broke out. They gave you this M formation, and right on the second leg of the M formation, that's when you have NFP. So you can see that the news also is used. They don't really care about the news. They just mainly care about this pattern. So what are the coincidences that the NFP results showed sells, and at the same time, before the NFP, they already gave you this inducement and gave you this M formation. And right on the second leg where we expect this to go down, that's right where NFP is, right? So this fat candle is the NFP candle, is the news candle, and you can see this beautiful M formation up here, consolidation. You can see that. So the news is basically an inducement, or basically a scam. They already know what's going to go on. They know where they're going to go before the news. So there are different variations of this pattern. So if you want to learn, this is a variation of the pattern. If you want to learn how to catch trades like this, click on the video on the screen and also like and subscribe, and I'll see you on the next one.